Well, another trading week has come to an end, and while investors warm up to the year 2013, I'm asking Eric Lascelles from RBC Global Asset Management for his take on market sentiment for the week ending January 11th. So Eric, China's exports rose by the biggest margin in 7 months, and the data seemed to be the main market mover this week, as it provided further evidence that a hard landing may have been avoided. What did you make of this data, and what other political or economical events would you class as having had an impact?
Right. Well, certainly the Chinese trade data is enormously important. China is the world's second largest economy. It's the biggest contributor to economic growth, and so what it does matters massively, not just for GDP, not just for itself, but also for things like commodity prices. And what we're seeing is very clearly the soft landing scenario playing out for China. The Chinese economic figures broadly have turned higher. Many of those were survey-based. We're finally starting to get some confirmation of the Chinese economy turning higher in the real numbers, the actual dollars and cents. And so these trade figures were surprisingly good. In fact, we saw exports rise 14% over the year, a big pop from the prior month, substantially exceeding expectations and suggesting that the rest of the world is starting to consume again, and that's very positive news. And similarly, domestically for China, import growth rising 6%, up from a flat figure before. I think we can really just say that the global trade gears are starting to turn again, and consequently it looks as though that downturn that really lasted through the summer and into the early fall, it's now behind us.
Central banks met this week with the ECB and BOE keeping rates unchanged and Poland lowering by only 0.25%. Are central banks right to stick to their guns as 2013 is in its infancy? And do you expect the likes of the Bank of Japan and US Fed to follow suit when it comes to their meetings at the end of the month?
The year 2012 was a year of policymakers and central banks, more importantly, and central banks around the world delivered enormous amounts of stimulus, certainly true of the Fed, true of the Bank of England, true perhaps of the European Central Bank, if in different ways, and the Bank of Japan was in there as well, not to mention any number of smaller countries and lesser central banks. My sense is that we should not bet on an outright reversal in policy in 2013. That is to say, if we do continue to get rate movements, they are more likely to be down than up. That applies to the European Central Bank, even with an on-hold decision this time round. I think it applies to quite a number of central banks in terms of the likelihood of the continuation of delivery of quantitative easing. The Bank of Japan certainly looks the most promising of the bunch, and so not only is there lots of talk of a higher inflation target, which would necessitate more stimulus to achieve, but there's even been some murmuring of perhaps unlimited stimulus styled after the recent U.S. approach. So I suspect it's almost certain the Bank of Japan will do now, especially with a new political party in charge and exerting pressure on the Bank of Japan. For the Fed, it's a trickier one to say. We can say they're doing a lot of stimulus right now. There has been some talk in the Fed of perhaps ending that at some point over 2013. That's certainly conceivable, but I think the distinct risk is a continuation of that policy as opposed to an ending. And even with the Bank of England and the ECB not doing a whole lot of note this week, the risk for the European Central Bank is still perhaps a rate cut at some point. The risk for the Bank of England is more quantitative easing as opposed to less.
If we look at Europe for a moment, Draghi stated the European economy will slowly recover but is not out of the woods yet. Similarly, some analysts are positive regarding the 17-nation bloc, providing a Greece, Spain, Portugal debacle can be avoided. But what is your outlook?
I think we have to be very careful on Europe in the sense that the European economy is almost certain to stagnate or even decline in 2013. Even the European Central Bank itself has a forecast of no growth, and so it's certainly fair to say that the European economy isn't out of the woods yet. However, it really depends who you're talking about, because the reality is this recession has in some ways been perhaps lighter than imagined at the European-wide level, and a big reason for that is it depends what part of the economy you're talking about. If you break it down and get rid of the public sector, the private sector has actually been hit quite hard. Domestic demand's been hit quite hard. Consumption has fallen just about as deeply as it did with the recession in 2009, but other items haven't been nearly as severe, and of course it's varied substantially by country as well. My sense right now is that we should see at least less of a decline for the European economy in 2013 relative to 2012, so that's a step. And more broadly, I think the important progress that's been made in the last year, it's not on the economy, it's progress that's been made with the debt crisis. And when I think of the progress that's been made, I feel a whole lot better about Europe and the risk of a crisis emanating in a more serious way there into the rest of the world. And it comes down to the European Central Bank finally stepping up to the mantle of lender of last resort. It comes down to the banking union, which is beginning to be formed. It comes down to some form of fiscal union, which is being considered as well. And really just the idea that European leaders have been very pragmatic. They've shown they've been willing to do whatever it takes, and ultimately the risk of the Eurozone breaking apart has to be down from where it was a year ago. The risk of a big bank failing has to be down, and the risk, for that matter, of a big country defaulting like Italy or Spain, it's not a 0% chance, but it looks to be down as well. And so my sense is somewhat more favorable. And so even with the economy in quite poor shape still, this could be an environment, in fact it has been an environment, in which European financial markets have started to perform. They are very forward-looking, and they recognize Europe is now on the ascent in terms of improving.
Finally, from an FX point of view, how do you think the CAD will shape up against the US dollar in the coming months?
My distinct bias is that the Canadian dollar is a little stronger than it should be. And when we run models and acknowledge that Canada has higher interest rates than the US, acknowledge there's a certain foreign safe haven flow that comes to Canada as well, and even acknowledging the presence of rather high commodity prices, the Canadian dollar still seems to be a little bit too high. And what makes me feel quite strongly about the idea that we should be losing several cents off the Canadian dollar as we go forward over the next few months and over the next year as well is really just the idea that the Canadian economy is possibly decelerating slightly. You wouldn't guess it based on the job numbers, but the real economic figures are, if anything, softening. And the basic fact here is that the U.S. economy, the housing market is on the upswing. Households are done deleveraging. They can consider beginning spending. In Canada, it's precisely the opposite. The housing market is beginning to cool, and Canadian households have overdone it slightly on debt, and they're beginning to retrench. And so somewhat different trajectories that should ultimately support a moderately softer Canadian dollar.
Well, that's all from Eric and myself at the moment. I shall leave you with some standout statements from our experts this week, taken from interviews which are also available on the Dukascopy website. Enjoy and take care.